Hello everyone. My name is Prashant, and today I'll be talking about rethinking investment valuation for the Agile methodology. I'll start with the basic information and then dive deeper into why I think that the conventional capital budgeting approaches doesn't truly capture the essence of flexibility offered under the Agile methodology. Therefore, a new dynamic valuation approach is required, which can supplement the original approach. I feel that this presentation is good for entrepreneurs, portfolio managers, investors, and project sponsors, etc. So let's look at the different objectives of digital initiatives which organizations strive to achieve. So the first one is about increasing revenue. So these are the new product introduction or the market capture, or new segment capture with the existing products. The second one is about reducing costs. So these could be your business process re-engineering for the back office operations work, or automation through robotic process technology. The third is a cost of doing business. I mean, we all know that organizations have to comply with regulatory, legal, and security type stuff. So these are the projects which have to happen because if you want to stay in the business. The last category, which I recently realized is related to ESG, which is environmental, social, and governance. And I've studied that recently that the organizations who are investing in ESG type activities have a higher market valuation, and they are doing much better as compared to the organizations which are not doing those activities. So let's start with looking at a typical cost-benefit analysis approach, what exactly it means for the organization. In essence, it's looking at the benefits cash flow minus the implementation cost. So the delta of that will give you a true essence of your cost-benefit analysis. The benefits comes from either increasing revenue or decreasing costs, or the combination of both, minus the operating expenses. And the implementation costs relates to your resources who are working on this initiative. It could be the infrastructure that you have acquired to do all that initiatives. So that's the very broad term for the CBA. And we'll be using that in the later presentation. So I just wanted to give that ahead of time so you can relate to it. Typically, we would want to account for the time value of the money so that we know that if we are comparing a project which is 2-3 years in horizon, you would want to compare that on the present time value. The most common way to measure the time value of money of any initiative is a discounted cash flow or the net present value. What it gives you is the time value of the future cash flows discounted back with the capital cost minus the initial implementation cost. So if the net present value is greater than 0, which means the project or the initiative is adding value in the organization, versus if it is less than 0, then you would want not to do that project because it's not going to add any value to the organization. The formula is pretty straightforward. You take the cash flow, net cash flow, and discount it back for every year for that project, minus the initial investment. So let's look at one very simple example. Let's say if you have a project which will take about $1,000 to start the investment, and you have projected that in the year 1 you will make $500, year 2 you will make $300, and the year 3 you will make $800. So what you have to do to calculate the net present value is to actually discount it back all yearly cash flows and subtract it with the initial investment. In this case, you would see the capital cost is 8%, which is the interest that you would give to acquire that capital. The NPV is coming out to be $355.23. So this is a positive project, and you should definitely invest in that. So now let's look at the conventional approach and how projects are done in organization. This is generalized, and many variations of this exist in different types of organization. But this is, in general, what an organization would do to go through the life cycle of any product or any project development. So a business would start with an idea. That idea might be, as we discussed earlier, related to a new product introduction or a new market with an existing product, or it could be a process digitization to generate efficiencies on those processes. The next is they will look at all the assumptions and look at the planning and see how much it would cost and come up with a decision whether to invest or don't invest. So this is where they would do the CBA and look at the net present value and see whether this makes sense or not to invest further. And then after that, once they say, yep, this looks like a good project for us to invest in, we feel that there's a positive net present value here, let's go ahead and invest in it. From that time onward, the analysis, design, development, all those things are happening sequentially in many cases. And at the end, you would release that project or the product or the idea into the market, and you hope that it does well. So between the cost-benefit analysis until the product is released in the market, most managers wait to see what happens. Were the hypotheses that they had initially in the business idea correct? Was the value captured as planned? So they really do not know unless the product is released in the market. So there's a huge time gap between when the initial idea was thought through and when it's released in the market. So there's a lot of gap, and many things could change in the market during that time period. To overcome that problem, there's an agile approach, which is mostly driven through test and learn. You would still have a business idea and you would do the planning, but your delivery is more iterative. So you have different sprints in which you plan, build, test, and review your product. You have different MVP version that you will roll out. I mean, for this scenario, I have simplified it. In reality, you may have multiple sprints before you could release a product. But in general, typically, a sprint could last between a week and 2 weeks in general, but every organization is different. The whole idea is you release out these MVPs and you test and learn in the market and see how they're doing it. And based on how these MVPs are doing it, you might change your approach later. So here is the comparison of conventional versus agile approach. So if you look at the parameters, the requirement has to be known upfront in the conventional approach. You need to know everything before you say, yep, invest or don't invest. Versus on the agile side, it's a test and learn approach. You start with an hypothesis and you have some basic idea, you do customer research, you get customer feedback, and you apply, let's say, design thinking methodologies, and you go out and learn about the customer. And then you start working on it. The development process in conventional approach is pretty sequential, analysis, design, solution context, approaches, and then you start the development and you testing, release, and production. In Agile, it's still sequential. You still do, plan for it, build it, release it, but it's more iterative and a shorter duration. So you're not doing a big bang type, development activities. It's pretty short. The cost benefit analysis, as we saw earlier, it's upfront. So you need to know whether to invest or don't invest. In Agile methodology, that approach doesn't fit very well. It's more a learn and adjust type thing. So since that approach doesn't fit very well in the upfront CBA, you need to look at the investments under flexibility, because Agile approach offers you that flexibility in changing the course correction. So Agile methodology allows you to test and learn and adjust accordingly. You have a course correction. You could defer, accelerate, or abandon the project altogether based on what you have learned in the market. The conventional CBA doesn't truly capture that essence of that flexibility because it only gives you two decisions upfront, which is invest or don't invest. So therefore, a dynamic valuation approach is required, which can account for all these uncertainty that an Agile approach is embracing and the agility that is giving to you. A conventional approach doesn't give you that. Let's look at the real options approach. So fortunately, there is a way to account for that ambiguity or uncertainty in a financial term. A real option investment opportunity is like a financial call option. It provides the right, but not the obligation to proceed. So I have put together a very small example, a very simple one. So let's say you have an option contract to buy a stock for $100 in 3 months down the line, and you would pay $2 to buy that contract. If the price is above $102, there is a profit, because you can buy the stock for $100 and sell it off for $110, let's say, if that's the price, and make $8. If the price is below $100, you would not exercise that opportunity, and you would not lose $100. You would only lose $2. So in this example, if the stock is trading $110 at expiry, the profit is $110 minus $100 that you pay for the stock, plus a $2 premium. So you made $8 here. If the stock was trading at $90, you would not invest in that, and you would only lose $2. So that's the essence of your an option. It gives you the right, but not the obligation to proceed. So a corporate investment opportunity is like a financial call option, because organization has the right but not the obligation to acquire or do something. This could be acquiring new asset or introducing new product in the market that we were discussing. So or implementing some cost saving measures in terms of digitizing your business process. So let's look at how do these real options map to Agile delivery approach. MVP versions, minimum viable product versions in Agile delivery, are like options, as they offer right but not the obligation to proceed. MVP provides us with the opportunity to learn more about the business hypotheses, about the markets or the customer or the new segment, those kind of things. Based on the learning, an organization may decide whether they would like to invest in the opportunity or not. So actually the MVPs are your options. And based on the initial small investment, you may want to invest more later based on the outcome of your MVP that you have rolled out in the market. Let's look at the conventional approach example. Let's say you have a project and you said, okay, we will invest $2 million in it. And we know that if everything goes right and our assumptions are right and the product does well in the market, we will make $2.5 million in the present value. But the worst case scenario is the product doesn't do well in the market. If we don't get the level of adoption we planned earlier, we would only make $0.5 million in the present value. So I would take those two and hoping that equally likely of happening those two outcomes and average it. And I find that the value that I'm getting at the end minus the initial investment is negative $0.5 million. So based on this negative CBA, the project will most likely not be pursued because you're not making any money in this project. So this was an example showing upfront CBA while you do not know a whole lot, so you are basing it based on the assumptions that you have made. I have purposefully simplified these examples, so these are not very complicated. In actual scenarios, the calculation may be a little bit more complicated. Now let's look at the same example in terms of real options approach. So let's say, okay, we'll do that project, but we don't know what will happen towards the end. Let's start with initial small investment of $0.25 million. And we roll out the version 1 of MVP. And if proved promising, we will invest further, $1.75 million in the next version. If it doesn't prove promising, we will not invest any further and we'll stop the project. So with a small investment, we will test and learn how that product is doing in the market. And based on that outcome, we will invest more if needed. So let's say we move to the promising part and we invested another $1.7 million, $1.75 million, and the present value of the benefit that we get was $2.5 million. And if we said the project is not promising, we will not invest anything, so our present value is zero. And based on the discounted value of the initial investment and what we would make in different steps of this process, it turns out that we would make $0.1 million towards the end. So a small investment upfront is actually giving you a positive CBA of $0.1 million. The project should be pursued because the NPV is positive here. So this is, you would not have learned about the benefit of this project if you had not known about the option methodology. You would have gone back to your conventional approach and this, okay, this is a $2 million investment giving you negative CBA, so we would not invest in this. By looking at from another lens, it gives you an opportunity to do projects which most likely would not have pursued and you would have missed that opportunity. But options is giving you that gap insight into that opportunity, so yeah, this is a good one that we should invest in. Let's expand on the concept a little bit further. So the real options are actually providing you a visibility into projects, volatility and uncertainty over time, as well as value to cost metric. So I'll explain what those two factors are because they are really important when you are evaluating these projects. The first one is your volatility and uncertainty. It is a function of variance of the project's return over time. So for an initiative with lots of unknowns, this value is high compared to an initiative where everything is known. So if you're starting a project where you do not know anything and you think that there's a lot of unknowns in the market to know about this project, this value would be really high. Versus if you are in a project which you are doing, which you know everything about it, this value would be really low. The second metric is value to cost. And value to cost is a function of present value of returns over cost. It's kind of NPV, but divided by the cost. So for the values that the one initiative, for values greater than one, the initiative will increase the value for the firm. And for the values less than one, it means it will decrease the value of the firm because your present value of returns are less than the cost. So these two are very important metrics. And we see how we map into an agile options space. It's kind of a 2x2 matrix where we have plotted value to cost at the x-axis and uncertainty, volatility on the y-axis, and divided into 4 different quadrants. Let's look at each of them. So on the very left-hand corner, you have initiatives where after a series of MVP, you have resolved all the unknowns. You know about that project, you know about the market, and you also realize that, hey, while for doing this project, we will not make any money because your value to cost is less than 1. So these type of projects or initiative organizations should abandon because they're not adding any value. But you would only do these kind of projects if these are for cost of doing business, as we discussed earlier. So it could be, some regulatory compliant type thing that you have to do, or a security issue that you have to fix to be, competitive in the market. The next one is on the accelerate corner. These are the projects where after doing series of MP, all unknowns are resolved, and you know that the value to cost is greater than 1. So you would actually make money here doing these projects, and they will add value to the organization. These are the projects organizations should accelerate to capture the advantage or the market condition or the technology adoption or the first mover competitive advantage. The next is defer or learn. These initiatives don't look promising because value to cost is less than 1, but they do have lots of uncertainties, and they should be deferred or slowed down until a potential business opportunity emerges. But you still want to keep them because you know that they can add value to the organization, but you do not know a whole lot about it unless certain situations in the market changes where you will come back and say, okay, yep, let's go, and this is the right time to do those. The last one is it's about go ahead and learn type initiatives. These initiatives look promising. Their value to cost is high, they're more than 1, but they also have lots of unknowns. So they should be further invested under the Agile methodology where you would learn more about it, and you would want to bring them down bring them down under the accelerate corner where you have learned more about them. There are not more unknowns left there, and you know that they will make money, so you would really want to do them. The matrix is designed based on an optional variables, and it is based on those two factors that I discussed earlier, value to cost and uncertainty. In conclusion, I would say the most agile delivery projects offer nested call options. So these are a series of nested call options, and they may start within defer and learn phase and slowly move down under accelerate. So based on how you manage them, you could generate additional insights into those initiatives, and can be really beneficial to the organization. Okay, so let's look at the conclusion of all of this approach. So most agile delivery projects offer nested call options. So these are a series of MVPs, and you can treat each MVP as an option. So once you do MVP version 1, you have option to proceed further or not do, or abandon it, or accelerate it if you find that, hey, this is really looking well. The real options approach is recommended along with the conventional approach because there's lots of similarities, and the good thing is its implementation is relatively straightforward, as most of the data needed to generate insights for options approach is already available with your traditional DCF, which is discounted cash flow analysis, or net present value analysis. So in summary, if you do the options approach, it will provide you additional insight that could really add value to the initiatives that you are doing. That's all I have today. I hope you find the session insightful. I look forward to receiving your comments and feedbacks. I would also be very happy to answer any questions you have. I have a detailed, methodology that I have defined in a spreadsheet that would be really helpful if you want to really dig deeper into how to implement that in your organization. I would really happy to answer any questions around that. My contact information is given here. You can reach out to me through email, or you can connect to me over the LinkedIn. Thank you so much for your time.